Business Valuation Update and Impact of the Tax Cuts and Jobs Act was a live webinar that was originally produced on Thursday, February 21st, 2019. For this webinar, we were joined by Eric Blocher and David Blain with McKonly Asbury. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Mel, thank you very much for your time and that great introduction. So well done. My name is David Blain. I'm a partner with McKonly Asbury, and with me today is our senior leader of our valuation practice, Eric Blocher. Eric, say hello.
Hello, everybody.
Thank you very much. Today we're going to be talking a little bit about the valuation world and how the new Tax Cuts and Jobs Act legislation that was passed in December of 2017 has impacted the valuation world and the valuation marketplace in regards to how we look at overall value of a business. So without further ado, let's get moving right along. As you can see who we are, here's Eric. Eric, want to add anything there to that robust resume?
Just to let people know that I lead our business valuation practice. I've been in doing valuations for over 20 years of consulting experience doing that. I valued hundreds of companies in my time. I've been in public accounting for over 28 years, and I've also qualified as an expert witness in the field of business valuations multiple times.
Excellent. Thank you very much. This is who I am. I'm a partner with the firm and I actually run our entrepreneur services group. I am a CVA as well. I work with Eric on some valuation matters. I usually do more stuff on the side of transaction advisory, due diligence type of work. But Eric is the guy. So we're going to let Eric kind of lead this conversation today more because of his background and expertise in the area. Just to make sure we're all on the same page, the objectives for today will be to obtain a better understanding of the business valuation process, its underlying principles, review the valuation impact of the Tax Cut and Jobs Act. We're going to talk a little bit about the industry and accounting for the impact of the act, learn some new topics affecting the business valuation industry, talk about buy-sell agreements and operating agreements. And as always, as we go through here, you can always submit your questions online, and we would be happy to take your questions and answer your questions. Kind of like this is like ESPN almost. It's almost like an ESPN sports broadcast, but we're going to be talking about valuation work. So first thing we're going to talk about is introduction to business valuation. We're going to talk about some of just the basic methods and understanding of valuation. I'm going to turn it over to Eric. He's going to talk a little bit about the three approaches to valuation.
Yeah, we wanted to primarily focus today on the Tax Act, but to get a understanding of that, I thought it was a good idea to go over some of the important things about business valuation for those of you that may not performed valuations before or have done them or had experience with them. We wanted to give you a little bit more of a background on it so you can understand it. As Dave said, there are three approaches to business valuation, and those are the asset approach, the income approach, and the market approach. So within any valuation, there are three different ways that it can be done. An important thing to keep in mind is that business valuation is no different than any other investment decision that you'll make. And I run into this frequently when I have to explain to a client or a judge or an attorney, why business valuation is different or why I'm doing things the way that I do. And the factors that we're going over here, I think, are really critical and important for people to understand so that they know why things are done. There are three factors that are considered in every investment decision. Like I said, valuation is just like any other investment decision. The first thing is the amount of return or cash flow that you receive from the investment. That's the first thing you need to consider. The second one is the risk of not getting that return. And how we account for that is by developing a discount rate or a cost of capital. And the third thing is the time period over which you'll receive your return. Now, there are other factors playing behind the scenes in any business valuation. And one of those is the principle, it's called the principle of alternative investments. It's even included in Revenue Ruling 5960, which is the IRS's guiding revenue ruling over business valuation. And it directs all valuators to make comparisons between a subject company, that you're valuing and other companies with similar characteristics. So what you're supposed to be looking at here is choices of alternative investments, and you need to make comparisons with alternative companies, because as an investor, you always have a choice of investing in, say, this company or alternative companies. So those factors and the principles of alternative investments are something that's behind the valuations also. The next thing is that a business valuation, it addresses all three of those factors. And something to consider is that every business valuation is a forward-looking, exercise.
Yeah, Eric, I think that's important for everybody to understand. I mean, when you're talking about value, and we're looking at what that business will be, not only just as of this moment of time, the value of that this moment of time, but what is the cash flow generation from the business? What is the economic benefit from the business moving forward?
Yeah.
Okay.
One of the things that we do is we always look at past financial information, but we don't base the value solely on past financial information. What we do is we look at the past information to see if it's indicative or to get a good idea of what the future might be. Everything is future and forward looking. We also consider the time value of money and of all of our considerations. A thought of that would be, would you rather have $20 today or $20 2 years down the road? And the answer to that is $20 today, because you always need to consider the time value of money.
So moving on a little bit here, Eric, as we talk a little bit more in detail about the the different approaches, being asset, income, and market approach. Let's talk a little bit about the details. Not too detailed, but just enough of a brief overview of how those approaches are used.
Okay. Well, the asset approach, it looks at the fair value of the assets, and that's both of the tangible, the ones that you can hold, and the intangible, assets that you can't hold. You take that and you subtract off the liabilities of the company, and the difference between the two would be the value of the company. And that's, the asset approach. But what you need to consider is an asset approach is typically only done from a controlling interest. And, how you can think of that, if you're a minority owner, you really can't force the sale of the assets of your company. So, that's why it's only done typically for a controlling evaluation. The income approach, it considers the cash flow an investor will receive from the ownership. Now, a distinction that I usually explain to my clients and attorneys is that we're not talking net income. When people think net income of a company, they think that's a good determiner of value, but it really isn't, because net income includes non-cash expenses, and more importantly, it doesn't include factors that you really need to consider to get the true value of a company, like working capital. You have to consider that. You have to consider the company's capital expenditure needs, because that's a direct cash outflow. You need to consider the debt service requirements. All of these things you must be considered, along with the tax impact. The income approach considers all of these items. It also considers the discount rate, which is the required rate of return, and that's used to convert the cash flow stream into a value. The market approach, what that does is that uses the value of comparables companies, either from a public market, which would be like the stock market, or transactions for companies that have recently sold, and you develop multiples and then compare and contrast the data from that to the data of your company, and then it can help you develop a value for that company. Now, the problem or issue with the market approach is that finding truly comparable companies can be really difficult. And sometimes you can look and you can find some, but then the company that is a public company can be 10 times the size of your company, and you really don't know if you can make a true comparison. Now, both the income and the market approach can be applied to both a minority or controlling ownership interest. That's different than the asset approach.
So, Eric, just a quick question for you is, I mean, in the amount of valuations that you have done in the past, what is the approach that you see most commonly used, and for what purposes?
Well, the approach that I see most commonly used is the income approach by a far and wide margin. Why it's used, I think it's the most adaptable. You can customize it and use it in any situation. And because we're always talking about future cash flows, it's always going to be important, because you can model out the cash flows, and you can also model out and factor in your required rate of return. But that's far and away the approach that I use most often, and I've seen used most. And we'll get into some reasons why a little bit later when we talk about the Tax Act.
Okay. All right, let's go on to the importance of standard of value and level of value.
Okay, the standard of value. Now, what that is that's something that needs to answer the question, who's the value, the value to whom, and under what conditions and circumstances. The standard of value, it needs to be defined in every valuation engagement, and it gives direction for the entire valuation. What some people don't realize is that the different standards of value will give you a different value for the same company. An example of some different ones would be fair market value. The typical, this is typically used in all IRS valuations and a lot of litigation valuations. And the definition is when a hypothetical willing buyer and willing seller, and they're aware of all the facts and circumstances of the business, and they choose to do an arm's length transaction. So it's used for all IRS, and you also consider all discounts under this standard of value. So a discount for lack of marketability and a discount for lack of control are factored in. Now, the investment value is another standard of value. Investment, it can also be called a strategic value. What that does is it's a value to a particular investor with unique motives or opportunities. And where this can come into play is if someone's selling an entire business and someone wants to come into that business either to get a new footprint for an area, or they have excess capacity which they're trying to fill, it'll allow the buying company to pay more than they would otherwise for it, unless they were going to run the business the same way it's always been run. So an investment or strategic value will be higher than a fair market value. And then fair value is the last standard, which is it's the value used for financial reporting and dissenting shareholder litigation, and it typically does not consider discounts. So all three of those standards of value will arrive at a different value for the company.
Okay. Let's talk a little bit about level of value.
Now, level of value is the next thing that needs to be defined, because depending upon the valuation method applied, a different level of value is produced. The adjusted net asset value method, which is an asset approach, that assumes a controlling position and will arrive at one value, where the guideline private transaction method also produces a controlling value. But you need to know what level of value you're looking for, because if you pick the wrong approach, you could have a different level of value that's different than what you need. And I think the next slide will show a little bit more details about that.
Yeah, I think what's important here is to understand at the end of the day is that depending on what you're trying to do will determine different levels of value of your business. Plain and simple. I mean, there's not just there's not just one specific value of a business, depending on what you're trying to do, whether it's and you're going to talk a little bit more about this in the future, talking about things like gifting or things like just selling your business on the open market.
Exactly. Now, on this slide, you can see that there are at least 4 levels of value here. And the important thing to understand is that within one entity, there's not one value, there's many. If you go to the top, if you look at the chart, as you go to the top, values increase, and as you go down to the bottom, values decrease. The 2 top levels, strategic control and financial control, those are enterprise levels. Well, what that means is that you're valuing the whole business. So if you're going to buy a business and run it the same way that it's been run, not change anything, you don't have any strategic inputs or things that'll allow you to improve upon its operations, you would be looking at the financial control valuation. If you have something where you could buy a company and then you could reduce its costs, you could expand your footprint, you could fill capacity, that would be strategic or synergistic control, and that value would be higher. Now, if you're valuing a minority interest, the level of value that you're looking at is either minority marketable, which would be equivalent to the stock market because it's a minority interest, but it's readily marketable, or minority non-marketable, which is typically what you see when you're doing a valuation for estate planning or gifting, where you're looking at non-controlling interests in a company that there's no readily available market for. So, and those two are shareholder levels, which are individual investor levels. So you need to know what the interest you're valuing is, so you can pick the correct level of value to try to arrive at. And this little chart here can give you some guidance as to what discounts apply, what don't apply to get to the different levels.
Okay. Next, we're going to talk a little bit about premise of value.
Yep. Now, there are 2 main premises of value which need to be defined. They also impact value. It specifies the highest and best use of the assets of the entity. The first premise is going concern premise. And what that means is that you're going to continue to basically run the business the same way that it has been run previously, or in a different strategic manner, but you're going to still continue to operate the business. So either you're taking it over yourself to run it as it is, or you're going to bring it within your business, but it's going to continue to operate. Then there's the liquidation value, premise of value. And what that is, that's either in an orderly or a forced liquidation. And that where it's deemed that to liquidate the assets is the best use for those assets. Now, the difference between an orderly liquidation, that means when you will take the time to try to get the best price, you still have to sell it, you realize that, but you're given enough time to try to get the best price for the assets of the company. Or a forced liquidation would be when you're forced to sell it as quickly as possible, and typically that price is much lower. You can sometimes have that happen when you have to sell assets out of a divorce situation.
Right. Okay. So we're going to go to the first polling question to make sure that everybody out in webinar land is paying attention. The first question is, have you had a business valuation performed previously? We'll give everybody about a minute here to answer the polling question, and we'll get back to this.
So Dave, have you ever had a business valuation performed?
No, I have not. I have not personally had a business valuation performed. What about you, Eric?
No, but I've done a few.
Yes, you have. Just a few.
Just a few.
Eric, I've known Eric for almost 15 years, and he's one of the best valuation experts in the state of Pennsylvania, if not on the East Coast of the United States. So, Eric, you're the man that gets it done. So I think we've gone through. I think everybody has answered the first polling question, so that's good. Keep paying attention. You only have another 40 minutes left, so we are going to go on to. We're going to take a look at these results. So the results have 80% said no on having a business valuation performed. So if you're a business owner that's on this webinar and you're listening in, this is probably some good information on this webinar to learn a little bit more about the valuation process and how it works and how can it benefit your company. So
I'm just glad there was no C's.
Yeah, C's.
Yeah, then I hadn't done my job with introducing it.
Okay, let's move on to the next one. So this is where we're at. This is the big item of the day. Eric gave everybody kind of a good brief overview of the valuation process, how it works, different levels of value, premises of value, and just overall the general concept of valuation. We want to talk a little bit more about how the new tax legislation that was enacted in December 2017 is impacting the valuation market. Those impacts were rather significant from the perspective of the reduced tax rates, how hard assets are being handled within the organization from a depreciation standpoint, interest expense and how interest expense is being handled, and how that flow down to anybody's personal return impacts them. So we want to have those conversations and talk a little bit about how this new legislation is going to impact the valuation market. So I'm going to turn it over to Eric and let him talk a little bit about the Tax Cut and Jobs Act.
Okay. Yeah, the tax, as Dave was talking about the act, it was passed on December 22nd, 2017. It became effective January 1st, 2018. Now, let me take a step back here. It was not quite that simple. From the valuation standpoint, I had some valuations that had taken place, or the effective date was immediately prior to the act. And one of the questions that we needed to ask was it known or knowable what was going to happen? And should you account for the implications in that valuation? And what we had to go back and do is we had to look at the legislative history of it to see when it was talked about, when it was passed preliminarily, what the impacts were, what was the likelihood of things passing. And what we ultimately determined was that, going back as far as maybe even the beginning of October, we felt that we could rely on that it was known and knowable standpoint, and we included the implications of the Tax Act in the valuation as of that date. But now we're moving forward to valuations that happened as of December 31st, 2018, and there's no question that The changes that have been made here, would impact the valuation. The act impacts both C corporations and pass-through entities, and that's something that's critical here because that covers every business entity that we're going to be valuing. The highlights of the Tax Act, and these are just highlights. There are many other factors in the Act that impact your personal tax returns that do not necessarily impact a business valuation, but don't just think that what we're talking about is the only thing that's in the Act. The highlights that have valuation impact include a new C corporation 21% flat tax rate, and that is a permanent federal, a permanent change in the rates, and we'll talk about the impact of that a little bit more as we go along. There are also temporary changes in individual income tax rates. Now, how does that impact it? Is because through pass-through entities, they're taxed. The income from a pass-through entity is taxed at the individual rates. So knowing that any changes in those rates will impact the value of a pass-through entity to that owner. The rates have been lowered and the changed income limits. There's new limitations on the deductibility of interest expense. And there's personal interest expense, but also business interest expense. So depending upon facts and circumstances, you may not be able to deduct all of your interest expense for your business, and that can certainly impact the value of it. There is now 100% expensing of certain capital expenditures. That could have a tremendous impact, and we'll spend some time going through that a little bit later. And they also have a 20% pass-through income deduction for qualified business income, or QBI deduction for certain pass-through entities. Now, those are just the ones that immediately came to light in the valuation world, and even after it was just passed, people were talking about it. We see a big impact from these, and then we try to figure out how to handle it. That's been happening the whole previous year.
Okay.
Okay, so the first thing is the new C corporation 21% flat tax rate. C corporations are taxed twice. And what I mean by that is there's a tax on net income, and then there's also a tax on dividends that are paid out. And dividends and or the share of your stock, if you own a C corporation, those are the only two ways that you're going to get a return on your investment as an investor. So more tax paid on that impacted the value of it. This was a reason, because C corporations were taxed twice, this was a reason why there were so many pass-through entities. People tried to avoid the double taxation. There's now a more level playing field. So you might see more C corporations pop back up or beginning to be looked at a little bit more, because you can avoid, or with the tax rates that they have lowered now, the impact is not as extreme between the two. And even if you pay the dividends tax, it still can be comparable to pass-through entities depending upon your business. Take a step back, all things being equal, under valuation, lower tax rates result in more cash flow to the business and a higher value. I think that some of the things from this, though, you don't want to take it just at face value. You need to look into it a little bit more. I believe we need to question how much value will increase. The Tax Act was designed to help increase wages and prompt new hiring. But will that really happen? I think from a valuation standpoint, we need to have discussions with the owners of the company to see if they're having savings because of the lesser taxes, what they're going to use those savings for. Could the money that they're saving on taxes be spent on new hiring? If that's the case, then there really is no new additional cash flow to the owner, because the tax savings are going right back into the business. Now we peel back that onion a little further. If there's more hiring, does that mean there's more capacity to possibly grow the bottom line? So there's all these things that really you need to look at and consider the implications of. Could the increased cash flow be used for more capital expenditures? If that's the case, that could also mean there's more cash outflow. Cash flow could be less. But does the purchase of the capital expenditures mean that the company is going to be more efficient and effective and have a better bottom line? It's a circle. You go around, you really don't know the answer. You need to dig into it and model things out. Is there a possibility that cash flow could remain the same, or is there a possibility that could even be less? It's not just the dollar for dollar tax savings that can impact value, but it's how it's used. You really need to look into it and see what are the next few steps. Now that we're saving the money, what are we going to use it for? And is it really a return to the owners that will increase the value, or is it just a reinvestment back into the business? And then does that reinvestment back in the business result in a greater return to the owner too? It's not a simple, straightforward answer.
So Eric, you know this the legislation got passed a little bit over a year ago, and you've been doing valuation work with organizations for the past year or so, and taking into account the new tax legislation. I mean, what are you seeing out there right now in regards to some of the items you just talked about in regards to is it when a good example would be, Eric, are you seeing that there is more of an emphasis on putting more money back into capital equipment in the organization? Are you seeing where they're using more of the additional cash flow for other expansions of the organization that would increase the value of the business? I mean, what are some of the things you might be seeing right now?
Typically what I'm seeing, or have been seeing the most of, is an increase in capital expenditures. You know, they're reinvesting it in the business. Maybe a slight increase in wages. It's either, most companies either have been putting off some, capital improvements, and now they're doing them because they have more cash flow, or other instances I've seen, we're distributing it all out. The owner wants their money now. So those are the two extremes. I haven't really seen, it go back into, a mix of them. It's either invest it back in the business, we're happy to have it, or the owner's going to take it out and put it in their pocket.
Okay. Let's talk a little bit about some of these other temporary changes in the individual income tax rates and how that's impacting some of the valuation concepts.
Okay. Both the individual and the married filing joint tax rates have been reduced, and the thresholds for when those rates begin have also been reduced. This results in tax savings for the owners and in general an increase in the value. If you have more money coming into your pocket, whatever supplying it's going to be more valuable. One thing to consider though is that there are sunset provisions. What a sunset provision means is that it's a clause that provides that the provision of the law is automatically repealed as of a specific date, unless legislators enact the law permanently. So what we have to do is we have to factor in these sunset provisions and the reduction in particular in the individual and married filing joint rates. Those run from 2018 through 2025, and then they sunset back to the old rates from 2026 on. So that's what happens is it goes back to the previous level, and you really have to account for it. And how do we do it? We'll talk about that a little bit more later on. But it's not just a new playing field forever; it's a short-term playing field. Now the corporate tax rates are permanent, so that change is going to be from here until new law is enacted. But some of these other rates and changes are sunset, so you really have a short window where you need to factor in their impact.
So if it's a pass-through entity and you're dealing with looking at tax rates at more of the individual level, basically what we're doing is we're saying that we're going to use the temporary provisions through 2025, and then after that, because we don't have a crystal ball, it's not telling us what it's going to look like after 2025. Our valuation approach is to go back to the old tax rates until we get further clarification on that.
Yeah, that is true. And to expand on that a little bit more, within the income approach, there are two general methods. Like I said before, the discounted future benefits method is one of them, but a capitalization of earnings method is another. And that's where you take a normalized earnings stream, and you capitalize it with a cap rate to value. What that method doesn't allow you to do is doesn't allow you to model in changes in tax rates for a specified period of time. And that's, once again, while I'm seeing the discounted future benefits method used a lot more, because that method will allow you to model in assumptions and facts and circumstances that change. So even though we still see the income approach used most often, we're seeing less of the capitalization of earnings approach versus the discounted future earnings approach.
Okay. All right. Thank you, Eric. Let's talk a little bit about the limitations on the deductibility of interest expense.
Okay. Yeah, this was something that was put in. Now, for interest expense that I'm talking about is the business interest expense. And this is a permanent change right now. There are temporary changes that affect, interest expense for like homeowners, deductibility of interest expense, things like that may change and sunset back. But this is business interest expense, so it's on long-term debt that a company incurs. Now, what it did is it placed limitations on the deductibility of it. Beginning in 2018, the net business interest expense deduction is limited to 30% of what they call adjustable taxable income. Now, that definition changes. Generally, adjusted taxable income, it's equal to earnings before interest, taxes, depreciation, and amortization, or EBITDA, without any QBI deduction, which is the 20% deduction, and that's effective through 2021. Then after 2022 on, it's limited to 30% of earnings before interest and taxes, and that's a lower number. So they're kind of letting us ease into the threshold that's eventually going to be there. This limitation can increase the tax liability and reduce the cash flow value of a business. So, the effective tax rate can actually be different than the new statutory rates if you have a limit on the interest that you can deduct. Now, the interest also that you can't deduct or that's limited can carry forward to the next year, which just makes modeling it out even more complex. But it's something that you have to consider going forward.
Okay. All right. Let's talk about something that seems to be the big topic of discussion with at least a lot of my clients that I see, and it's regarding the changes in the tax code regarding Section 179 and also bonus depreciation and how that's impacting the decisions that they're making going forward. Let's talk a little bit about how that impacts the valuation when we're looking at an organization.
Yeah, this certainly has been a topic of discussion from the moment where they enacted the Tax Act. We had some valuation conferences. This was highlighted, underlined, arrows pointing to it as being important. What this does, it changed the bonus depreciation percentage to 100%, allowing full expensing for qualifying assets purchased from September 30th, 2017, even prior to the enactment of the Act, all the way through December 31st, 2022. So you have 100% expensing. The percent then drops down to 80% in 2023, 60% in 2024, 40% in 2025, 20% in 2026, and 0% thereafter. What this does, and I can't stress this enough, is this bonus depreciation results in real tax dollar savings in the year of the purchase. It's real money that you're not going to have to pay tax on, which represents real cash flow and an increase in value. Now, the tricky part, which I don't think everybody considered, is that this advantage expensing of the capital expenditures, it reverses itself over time. And what that means is that there's less depreciation in later years, so the present value of the tax savings or each year, you need to calculate it, and you need to do some calculations on it. Good, and more that get into that more detail shortly. But you have to factor in the timing of it too, and I don't believe people are considering the timing as much as it should, because of the reversing of it. We believe that a discounted future benefits approach is the best way to account for the value of the tax savings. And all things being equal, this results in higher values, or should result in higher values, because you're having tax savings closer to the present date. I've talked to evaluators across the industry, and some people are handling it differently than others. I've spoken with some that just say they're ignoring the bonus depreciation issue because they don't believe it's material. They're just going to normalize depreciation and handle it that way. I believe I've seen other evaluators that are handling it just looking at every year. They're just looking at the positive impact of the current year purchases for bonus depreciation and future purchases and accounting for that impact. I still think, and I'm convinced that they're missing the boat on this, and I think the things we're going to go over shortly will point that out.
Okay.
Like I say here, however, all things are rarely equal. And this is where some of the conversations that I've come up with. What happens if you're the investor in a company and miss out on a big year of bonus depreciation tax savings? You don't have this write-off this year. If you miss out on it, it reverses itself. So you got to account for that. I'm convinced that you must consider not only the bonus depreciation tax savings of future capital expenditures, but you have to look at the book's tax depreciation differences of past expenditures, the reversing of the impact from the earlier years. The examples that we're going over, here shortly will point, that out, and so and the importance of it.
Yeah, let's get into those. Let's keep this thing moving here and get right into those examples. Let's talk about this first one here.
Okay, in this first example, some of the things to look at is the assumptions behind it. The first year is 2018, and in year one, which would be 2018, there is a $5 million asset with a 5-year life purchase and a $10 million asset with a 3-year life purchase. Every year after that, there's a $1 million asset with a 5-year life. It also assumes that there is no previous book to tax difference for previous depreciation. So what it does in the first column, this is the taxable impact of the bonus depreciation. So each year, in year one, we expense off the $15 million of the capital expenditures is all an expense, and the taxable impact of it is tax depreciation exceeds internal depreciation by $12.8 million. And then over the next 13 years, the impact reverses itself. And you can see where it comes down and totals to zero. So the total taxable impact of internal versus tax depreciation, that's the tax impact. Then what we do is we look at the tax rates to see what the tax savings are. And you can see through this use of the discounted future benefits method where we've modeled different tax rates. We have 33% going out through year 2025, and we have the rates sunsetting back to an estimated 41.5% after that for the sunset provisions. So then for each year, we calculate the tax savings for each year, and then we've assumed a discount factor or a discount rate, required rate of return, whatever you want to call it, of 20%, and calculated the present value of each of these tax savings. The net present value of all these add down to be $1.5 million of value associated with the bonus depreciation benefit. So that would, in fact, if you're doing the valuation in 2018, that would be a factor to add back into the value of the company just because of the difference between bonus depreciation and internal book depreciation.
Okay.
Now on the next slide, this is year two, and what this assumes is that you don't look back. Oh, it's a new year. We'll just start with, the assumption that now, consistent with what happened in 2018, is, there's just $1,000 or $1 million asset purchased each year with a 5-year life going forward. And the first column also looks at the taxable impact of the bonus depreciation for each year and future purchases. It doesn't look back to see if there's a book tax difference, and then it calculates, goes through the same process and calculates the present value of the tax savings for $376,000 that you would add to value. I think this is wrong. I think this is a short-sighted approach. The next slide is, I think, how you need to look at it. The next slide does the same thing for the bonus impact of the current and future capital expenditures, but it also looks at the taxable income impact of the internal versus tax depreciation. That's the middle line. It is the reversing of that $12.8 million benefit that you got in 2018. You have to account for it in 2019 going forward. That impact is $12.8 million. You follow along to the right, you see there's the total taxable impact, the same tax rate, the same discount factor, but the tax savings or cost is much different. If you consider the reversing of the bonus in 2018, you now have a $2.8 million detriment to value. So if you're a person that's coming in and investing in a company beginning in 2019, I think you certainly want to know where you stand on the bonus depreciation, or you wouldn't have considered the fact that you're going to have excess income because depreciation is going to be much lower. There's a $3.2 million difference between the two values if you don't consider it.
Yeah, I can see where you're coming from there, Eric, too. I mean, that basically, if you were buying today and there was heavy bonus depreciation in year one, you're going to be buying on that value of that bonus depreciation in year one, not taking into account the reversal of it into the future, and how that's going to impact your value and your cash flow position in the future. Okay.
Yeah, if you miss it and come in the second year,
right.
This summarizes what we went over. Is the first example shows the impact of 2018, capital expenditures and future capital expenditures for bonus depreciation. The second shows only the impact from future capital expenditures 2019 on. The third example shows the the impact of the future capital expenditures, but also the differences between the two. And I think that's how you need to look at it. The impact of book and tax depreciation differences from past capital expenditures, it could be material. I don't see, another thing to think about though is you always should consider this if you're valuing a minority interest, because they can't change anything. If you're valuing a controlling interest and you're the buyer, bonus depreciation really might not impact you, because when you buy a company, all of the fixed asset values are going to step up and reclassify and start from zero. So you're not really concerned with it. But if you're the seller, you certainly would be concerned with the tax aspect of it. So you'll want to factor in the book tax differences, because it's going to impact the gain on the sale of your assets you're going to have to pay.
Okay. We're going to move on to the next polling question. You should be getting the polling question up here on your screen. So all three, if they're all three in the freezer, which are you going to grab? Is it going to be a Hershey bar, a Snickers bar, or a Reese's peanut butter cup? Give everybody a chance to go with that one. Eric, how would you answer the question? I just want to know.
There is only one answer, Dave.
I got the feeling it's going to be the Reese's peanut butter
It's going
cup.
to be C.
It's going to be C for you.
Absolutely. Okay. You could put peanut butter on a bumper or a rock and I would eat it.
Wow, that's a heck of a no there.
Yes, it is. I'm a strong C.
Strong C. That's good. Well, I'm a peanut butter guy too. I got 2 kids with peanut allergies though, so I have to be cautious with that answer. But still waiting for 1 or 2 more responses here. Okay, I think we got all of our responses. Let's take a look at the answers to the polling question here. All right, 52% coming in strong C there, Eric. You should be pretty happy with that.
Oh, I'm happy. I'm happy.
Good. All right, well, let's just keep moving along here. Let's get to the next set of items on this on our presentation tonight. We're going to talk about qualified business income QBI deduction. Another thing that's big with a lot of the pass-through entity owners, and how this qualified business income deduction works, and how it might impact your valuation as you're looking at a business.
Yes, it certainly can. So in order to level the playing field for pass-through entities with the C corp tax reduction rate, they risk having them come back and say, well, now we're not going to have any benefit at all, so we're not going to exist. But what they did do is they established a 20% QBI deduction. The calculation to determine whether the deduction applies and how you get to it can be quite complex, but there are flow charts out there that can help you go step to step to determine the impact of it. And if you need it, you can certainly email Dave or myself for it, but it's beyond the scope of this webinar really to go through the details of it. But the QBI deduction comes into play when calculating the appropriate tax rate to consider for pass-through entities and ultimately their cash flow. The bad news is that certain service businesses, generally speaking, accountants, appraisers, consultants, lawyers, and doctors, with income over certain limits, they don't get the 20% deduction. Our lobbyists were not as good as others for doing their job. So unfortunately, we don't get the QBI deduction. But another thing to consider is that the QBI deduction will also sunset on December 31st, 2025. So these are just more things you need to factor into and model into your valuation.
Okay.
Okay, so how do we handle all the sunset provisions? To address the issues arising from them, the bonus depreciation, interest expense limitations, which it doesn't sunset, but it's still something we need to account for. The personal individual tax rates, which do sunset, the qualified QBI deduction does sunset. The profession's focusing on modeling out the impact. And the approach to modeling, it varies based on facts and circumstances, because one of these might not apply to you, another one may. But the easiest and best way is through the use of the discounted future benefits method. And across the board, the valuation industry is supporting this. They're really looking to this method for determining the impact. And you saw a little bit from the examples in the past about how you can change some assumptions to show that. You can't do it with the capitalization of earnings. You can't do it necessarily with a market approach, because if a transaction happened prior to enactment of the tax law, it was transacted under old tax law assumptions. So really those multiples don't apply on a go-forward basis. So really the best way I think to handle the tax act is through the discounted future benefits method.
Okay. All right, we're going to talk briefly about some new resources for determining cost of capital when it comes to the valuation approaches. And we're going to talk a little bit about some of the build-up methods, the Duff and Phelps build-up method. It's kind of interesting. I remember back in the day, the Ibbotson build-up method was the big method to use. And just recently, over the last number of years, I'd say we've moved more to a Duff and Phelps model, which is similar to the Ibbotson approach. But it's a little bit different in regards to the portfolios and the size values of the businesses and how that's handled. So,
well, a little bit of background. When we're looking at determining the cost of capital, what we're looking at, as I said before, is this is the risk-adjusted required rate of return that you will want for an investment in a business. Now, the starting point also goes back to the alternative investments that I spoke about earlier. Why would I invest in the equity of a small privately owned business over investing in the stock market, which I know what that's going, what the rates of return are on those. And that's these methods that we're talking about building up the cost of capital are based upon historical returns from the market as an alternative investment over time. And within the build-up method of determining the cost of capital, evaluators have traditionally used data from the two sources. Dave touched on them, briefly. Both of these sources are now owned by Duff and Phelps. The first source, primarily, was Ibbotson Associates in the past. It follows the same format that they used, and it prevents cost of capital data based on the historical equity risk premiums from 1928 through present day. It's a long time. Size premiums in this study were broken out into deciles. So every tenth, it had a breakout for what the equity risk and size premiums were. Why I went back to 1928, that's when they began collecting the initial data for it. And then also it was thought that to have a longer time frame was a good thing. Under an income approach, you make either, when you use a capitalization of earnings approach, you're assuming you're capitalizing earnings or benefits into perpetuity. And I've been on the stand before, and attorneys have brought up that perpetuity is a real long time. So the longer that you have, I think, of a time frame to compare what you're building your cost of capital off of with, it makes sense to me then that you can say, well, it applies into a perpetuity assumption. So the first source started from 1928. Now the second source was the DMP, or Duff and Phelps Risk Premium Report. And that presents the cost of capital data broken out into 25 different sized portfolios. And then each of these are based on 8 different factors. So what this discount report, or this premium report, allows you to do, it allows you to compare 8 factors of your company with 8 separate factors and 25 different portfolios within those factors. So you can mix and match a little bit more, and I believe get a better fitting cost of capital estimate based on historical returns. Now, but this is only based off of information from 1963, because that's when they started having available the data from the 8 specific factors. So I think you can tailor your company to historical returns a little bit better using the risk premium report, and that's the one we rely on most readily here. Now, both of these sources use Center for Research in Security Prices, which is called CRISP data, or market return data from the University of Chicago. So they're based off the same data, but how they kind of look at it from the time frame and historical returns, above a risk-free return over those time frames, give you a little bit different look.
Okay.
Now, there's something new. BV Resources Cost of Capital Professional Platform. It was introduced in late 2018. It develops equity risk premiums and size premiums from the same CRISP data as the other 2 sources, but it treats it a little bit differently. This platform gives the ability to control the beginning period from which you can develop the historical returns instead of being, forced into 1963 or 1928. Now, potential issues addressed. I sat in a webinar when they went over this and explained what you can do and how you can manipulate the data. And they talked about the ability to look at rate of return from 1983. They picked a point that's a point when they started having different types of data available. But using 1983 as the beginning point, you faced an elimination of a size premium depending upon the starting date. Now, my personal opinion is I don't know if this is good or not. I'm still waiting to see how it all hashes out in the public court of public opinion. But not having a size premium, that's contrary to how most evaluators have used the application of the build-up method historically. This method considers data sources other than CRISP data, which is not traditionally included in the build-up method. It considers estimates from DeMotorin and New York Stern School of Business and factors other things into their estimate of the cost of capital data. The method of calculating the historical equity risk premiums is different than the other two sources and how they do it. Even using the same starting point arrives at different estimates from the other two sources. And my main concern with this is the need to explain why you would change going from a source that you said was reliable to a new source and having to explain the difference there. And that's not something I'm ready personally to do yet. I like to wait and see how the industry as a whole addresses some of the new thoughts that are out there before we typically jump in. And I'm still comfortable using the data that I have been from the DMP risk premium report.
Okay. Well, Eric, we're running a little short on time here. We want to save time for one or two questions. Is there anything specific with the Pennsylvania LLC's PA Act 170 Act that you want to address briefly that anybody should really be focused on or paying attention to right now?
Yeah, there is. I read an article about it, and it caught me off guard because I didn't realize that something like this could happen. So basically, it's a new LLC law. The new LLC law, Act 170 for Pennsylvania LLCs, it requires default rules to govern the management of the LLC when the operating agreement is silent on an issue. Now, follow with me along here. The default rules under this section of the Pennsylvania law provide that matters before the members will be decided by reference to the number of members per capita and not by reference to the governing interest, which means pro rata. Now, we go to the next page, you'll see how this and why it can impact it. So assume that an operating agreement for an LLC is silent on the voting percentage required to approve the sale of all the company's assets. If you have a company that has 3 owners, a 90% owner and 2 5% owners, under PA Act 170, the sale of the company's assets could be approved by the approval of the 2 5% owners, because that's 2 people to 1, and not the 90% majority owner if the operating agreement was silent on it. It's the number then under the default rules versus a percentage. So we're recommending that all PA LLCs review their operating agreements very carefully. You want to make sure that your operating agreement indicates how all important decisions should be made, either by majority vote or what percentage. But you don't want to be caught not having it covered.
Let's get to the final polling question. I think this is Eric's favorite one of the day. Which one is correct? And there is only one correct answer here. So we'll give everybody a second to look at that polling question. Eric, how would you which way would you go on this one?
All that I will say is that my house knows which is correct. I've had to instruct my kids on how to do it. I'm going to wait till I see the results to know, but there is only one answer. I truly believe that there's a passionate following for the correct way. Or at least I'm hoping.
Passionate following. Okay, I think we got all the polling results in. I'm sure everybody's waiting patiently to see the polling results. Over the roll, 94%. Eric, is that how you are?
94% of you are correct. I don't know who the under the roll was, but there's still time to learn.
All right. Well, there's two more brief slides relating to buy, sell, and operating agreements, and I think what we can do is just briefly take a look at those real quick. And buy sell agreements in operating agreements out there are definitely an issue that we see on a regular basis. A lot of language that's in there is very old, and something I guess the long and short of what we're trying to get here with everything here is that buy-sell agreements should always be reviewed at least every 2 years, probably at the most. I mean, don't let those linger for 10 or 15 years. There's a number of different things specifically relating to tax law and tax changes and just valuation approaches that could impact how a buy-sell agreement should read. So is there anything else that you want to add there, Eric?
Yeah, this is one of my soapbox topics. I love getting on my soapbox and talking about this because I've been involved in litigation over this issue more than any other issue that I've been involved in. Buy-sell agreements, even the best buy-sell agreement that I've run into, from a legal standpoint, could be crystal clear, but attorneys aren't evaluators. And, when the agreements are drafted up, it's usually at the beginning of a business and people have an idea of maybe what they're looking at, but they don't truly have a great idea, of the value of the company, but they'll put something in, they'll put a formula, an estimate of value. And, a year down the road, it's not going to work. So I really believe that you should have your value or your buy-sell agreement looked at from a valuation perspective, because if you don't, chances are it's going to be vague, unclear, or just plain bad. And I've looked at hundreds of buy-sell agreements in my career here, and the ones that were well done, from the initial, I can count on probably one hand.
Right. I know you and I just recently, over the last couple of months, looked at a buy-sell agreement of one of our clients and made some significant changes to their agreement.
Yep.
So let's just there's the questions, and thank you from Eric and I. We're almost at the 3 o'clock high witching hour. We do have at least one question that came in that was posed, and Eric, the question relates to the current legislation, federal legislation that's out there, and the fact that we have a Democrat House of Representatives. And the question is if do you recommend looking at doing two types of approaches with in regards to the evaluation, looking at it from the current tax legislation that's in place and also looking at it from the old tax legislation that's in place?
Well, I think you have to, as of right now, from a valuation standpoint, you have to consider what's there. It's not going to be changed for a while. And then it also sunsets back. So I think you need to consider it from both standpoints. What the impact is currently, and then what it'll be when everything reverses itself off. Because if you don't, you're not capturing what the true potential outlook would be as I see it right now.
Right. I think, I think what they're trying to get to is that the current legislation is the current legislation, but if you see that there possibly could be a change in that legislation just because of the dynamics of Congress, if you were someone that was investing into the business, you might want to know that now versus down the road. Or if you're trying to sell your business, you might see a situation that might drive you to try to sell your business sooner rather than later. Would that be?
If it's from a sale point where you think it's worth more now than it might be in the future, I would say, possibly go for it. But from a valuation, if it's for tax purposes or IRS, something like that, the known and knowable standard comes in. And just because something might happen out there, I don't know that it's known and knowable and you would be able to factor that in. Okay.
All right. Well, everybody, thank you very much for your participation today and listening to this topic, talking about the Tax Cut and Jobs Act and impact on valuation. I'm going to turn it back over to Melissa Roberson.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us online at macpas.com. Thanks again and have a great day.